Welcome to One for the Money, the weekly talk show with interviews you can use. I'm national financial columnist and talk show host, Steve Savant. And on today's show, it's tax time for 2013. We all know that taxes are due April 15th. But did you know that Tax Freedom Day could fall into May this year? Last year it was April 17th, but with higher taxes this year, you could be working for Uncle Sam well into the month of May. And to help us with our taxes and walk us through the basic understanding on deductions, exemptions, and tax credits, with me today is tax specialist Ken Davis, national columnist, certified financial planner, and CPA, all here on One for the Money. Well, welcome to the show, Ken.
Hey, Steve.
Well, it's that time again. It's tax time, and I have to say, I have to go back to the beginning of the United States. One of the premises of taxation was there should be no taxation unless we have representation. So we have that. And so if we have a gripe about what we're paying, we need to talk to our representative and say, hey, you need to either trim it down or we're okay with it.
That's exactly correct. We have a responsibility to communicate with our congressmen and to vote our conscience on what we think is correct.
Well, when I think about it, we're looking somewhere around $17 trillion in debt right now. And if I divide that up against every American's probably going to owe maybe around $54,000. But not all Americans pay federal debt, federal taxes. So the people that do pay, which is only about 53%, really pay, if they had the bill put to them today, we'd have to write a check for about $150,000 each.
Yeah.
Now, that's a lot of money.
And you can even argue that it's more than just what's on the books, because Congress is quite good, adept at hiding things like there are unstated liabilities for future promises and social benefits that have not been put on that balance sheet of $17 trillion.
When you think about it, if you go out to the website, truthinaccounting.org, you'll hear exactly what Ken's talking about, because it not only includes the U.S. debt at almost 17 trillion, but also all of our obligations, pensions, Social Security, everything all in, and it hits about $72 trillion.
You know, as we talk about this, it sounds so negative, and it is negative. However, I got thinking back, there have been presidents, and I don't want to get political, so I'm not going to name names, but there are presidents who have taken an attitude of we can grow ourselves out of the problem, where we can ignite the economy and can have a positive message, of can-do message that the Americans can rise to the occasion, and that message resonated. In fact, I can think of both Democratic and Republican presidents that have had a positive message that have stimulated people to take action and to grow. And I think, as opposed to focusing on raising taxes or how awful things are, if we can focus on getting America going again and providing jobs and increasing revenue so that we actually have the money to pay for that debt, that's really the positive way out of this process.
Well, when I think about it, last year we celebrated Tax Freedom Day. You know, that was April 17th. But because of the new taxes and all the new laws that are on the books now, we may break the year 2000's actual date of May 1. Wow. Now think about that. They're still calculating it. We can't even tell you what it is today. That's how bad it is. So sometime in May, we may actually have our Celebrate Tax Freedom Day. That's the time where we now start working for ourselves. We paid all of our taxes. But when you think about it, if we're pushing into May, and I laugh because people say, well, Steve, you're not as bad as Europe because Belgium is in August. Now I want you to just think about that. Some of the European nations are well into the summer that their tax bills are paid, somewhere around July or August, when they can start working for themselves.
Well, that's like saying, well, gosh, I went to Dillard's and got a purse for this amount, and I went to Gucci and it took me this many months to pay for my Gucci bag. It's like, you know, do I really need a Gucci bag? And that's part of the question of what we have to ask is, yeah, we need government. We have very legitimate uses for government, and we need to pay for that. The question is how much government, and when is enough, and when are we paying Rolls-Royce types of taxes and costs for the services and benefits our government provides us. It's really a cost-benefit type of analysis. So it's not that we're just don't believe in government or taxes and whatever. It's how much is appropriate, and what are we really getting in return as American citizen?
Well, think about it. There's going to be a time where the taxation, if it gets too high, it will actually become counterproductive to the country.
Well, yeah, it's interesting. A Nobel Prize-winning economist, Arthur Laffer, developed what's called the Laffer curve, and it basically says we know on the curve, if we have a 0% tax rate, we have 0 taxes. If we have a 100% tax rate, we have 0 taxes too, because who works for free? Somewhere in between there, and on that curve is this maximum amount where as you raise taxes, people say, I'm not going to work anymore, or I'm going to leave the country, or I'm going to do a cash-based business and not report it. I mean, there's a variety of different ways that people respond to excessive taxation, and unfortunately, we don't actually increase the revenues. What happens, they actually decrease, which is counterintuitive, but it actually works that way.
When you think about it, we could be turning into the barter nation. I mean, it's already happening, kind of an underground economy by itself. Now, Ken, when we're talking about it, we want to prepare for this. Now, remember, there's a lot of rules of engagement when we're doing our 1040, when we're filing our taxes. When we come back on the second break, we're going to walk through the big three. But just as a kind of a, before we close out, when you think about taxation, and talking to a professional about this, you think this is really necessary? I've heard you say this many times. We got to talk to a person that knows what they're doing.
Well, that's exactly right. I mean, there's no way. There was a time when I started in this business where if a client called me up when I was working at a big 8 accounting firm and said, gee, I'm going to do this, what's that going to do to my taxes? Well, I could fairly quickly, off the cuff, tell them, well, it's going to cost you so much. Well, today, because of various deductions, credits, exemptions, inclusions of certain income like Social Security, alternative minimum tax, all these different machinations the code has, it's truly impossible to know what the bottom line is unless you use a sophisticated tax program, and that's what a tax advisor can do for you.
We come back, we're going to talk about 3 of the things, exemptions, deductions, and credits, right after the break.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to our second segment. Of course, I'm with Ken Davis, CLU, CHFC, CFP, and hey, CPA. The reason you're here. Ken, we talked about in the first part, why are we taxed, some of the things that our country is up against, some of the challenges. But let's talk about the big 3 things that most American taxpayers are faced. They can use tax exemptions, they can use tax deductions, and they can use tax credits. They're different, and I want to be able to kind of make a description for each category so that we can understand what we have, because there's rules of engagement here. So let's talk about the first one, my favorite, tax exemptions.
Well, tax exemptions are things that are given to all Americans. Like you get one exemption for each taxpayer. Then you also have exemptions for dependents. And there are different examples throughout the code, but basically they are a deduction against our income to determine how much tax we pay.
So if let's say, for example, the typical one is a married couple, 2 children. So they're each going to get a standard deduction. I think this year is like somewhere around 37, 38.
Okay, we just switched from exemptions to standard deduction.
I was testing you, Ken, just to see. Okay. Let's talk about, when I'm talking about exemptions for myself.
Yes.
Exemption for my spouse.
Right.
Exemption for my children.
Yep.
Is there any other exemptions that I'm looking at besides those 4?
Well, there's one I believe, and quite frankly, I don't prepare taxes anymore, so it doesn't immediately jump to mind, but I believe for blindness, age 65, stuff like that.
So if you maybe had a relative or you were yourself, there'd be another possibility. Okay. So people that have, I guess that gives the right, if you have a big family, this is a pretty good idea. And I remember early on when my eldest son came back from school, he basically found out about the exemption that I had for his life, and he asked me how much that I owed him, and I told his mom to bill him for everything that he's been doing for the last 18 years.
You know, another funny thing was we used to tease the tax CPAs. I mean, this is nerds in action, right? We used to tease them if their children came like in January. Well, my son was born on January 28th, and that's a bad thing. You're supposed to plan when you have children to be like December 31st of the year because it applies for that year's tax return. So I was too late in terms of having my child delivered.
Wow, so a little early planning on conception could really make a difference.
Well, there you go.
Wow. Well, think about, okay, so we're talking about exemptions. Now, when we move into deductions, this is really the heart of it, and there's a lot of debate right now on deductions, especially the mortgage interest deduction. Talk a little bit about some of the major deductions looking into a 1040.
Well, and let's talk even a little higher level. The fact is the way tax returns work out is you have your first page and your second page, and on the first page you have your gross income minus business-oriented deductions, things like IRAs and other kinds of things, and self-employed people can take their health insurance deductions what they call above the line. Well, the line is adjusted gross income on the bottom of the page. Why do I bring that up? Because a whole lot of deductions, exemptions, credits are phased out or increased based on what your adjusted gross income is. Well, you want AGI as low as you can get it, so
Adjusted
having
gross
an
income.
above the line deduction is more valuable than a below the line deduction. Below the line is page 2 and is where we have itemized deductions. So I think when people think of deductions, they do think of IRAs, but they also think more of mortgage and interest, interest on your mortgage and taxes, property taxes, etc., medical expenses, casualty losses, various types of things. Those are below the line, and so they don't affect adjusted gross income. So they're less powerful than deductions that are above the line. So if you want to get some sense of your planning and you don't fully understand the tax law, just pull out, go to www.irs.gov and get a copy of the 1040 and just start looking at the line items and see where deductions flow in the tax return. And you can just say as a general rule, deductions above the line are more valuable than deductions below the line.
Well, I think that's really helpful, and especially when you think about, I never thought about IRAs being like a business idea or a deduction. But that's really a great idea to think about your first page. Those are the most valuable. Now, the last one we're talking about, this is a little strange because I always thought tax credits were solely and 100% if you owed taxes, you get a credit. But some people more in the poverty areas and so forth, they also get credits, and they could actually get money back from the government. So talk about those two different types of tax credits.
Well, first of all, let's talk about a tax credit versus a deduction. If I have $1 in tax credits, okay, that means no matter what my tax rate is, I come up with my tax bill, I get to subtract $1 against the taxes. Deductions, on the other hand, are dependent on what your tax bracket is. If I've got a 25% tax bracket and I have $1 deduction, I only reduce my taxes by 25 cents, not $1. So first of all, credits are much more valuable than deductions are. So you look for those opportunities, and again, look at the tax return and the instructions. You'll find where those things are. What you're talking about is a refundable versus a non-refundable tax credit. Refundable means that you may have zero taxes due, and you're going to get a refund of those refundable credits, whereas a non-refundable credit are unused.
I like the idea of tax credits. In fact, actually, when you're buying a new home, and I'm looking for my retirement home right now, I'm looking at all the tax credits for fixing up your home. They're all over the board. So you're saying, wow, that's dollar for dollar, whereas the deduction is only whatever your marginal tax bracket is and that number.
That is correct.
To me, that's huge. When we come back, we're going to talk about passive income and in capital gains, just to get you up to speed on what kind of types of income there is right after the break.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back. Of course, we're with Ken Davis, CPA. And boy, I'm telling you, Ken, I'm looking at, before we get into the three types of income, let's just do a small touch because some things have changed in capital gain treatment. Let's just talk about that because that could affect some of our viewers.
Yeah, I think capital gains are pretty well known, and basically just remember that time is important. If it's more than 12 months held, a capital asset, meaning stocks, bonds, real estate, things like that, then if they have a gain, it's long-term capital gains rates, which we've been taught to believe it's 15%. Well, now those people that hit a 39.6% tax bracket for ordinary income taxes are now subject to a 20% capital gains tax. So that's a big change for those with large sales, like maybe somebody has an apartment complex and maybe each year they have very little capital gain. Suddenly they have this huge capital gain in 1 year. They pop into that higher tax bracket. Now they're going to have to pay
it could be huge.
Not only higher income taxes, but also the estate tax. Not estate tax, capital gains at 20%. So that's new for 2013. The rest of it stays fairly constant, and there's really not a lot more to report.
Okay, but for people that are up in the upper brackets, that's an issue.
Oh, it's a big deal.
All right, now let's talk about, we've talked about, in the last one we talked about tax exemptions, deductions, and credits.
Yes.
Now let's talk about the three forms of income.
Well, this is interesting. Back in the 80s, when, well, actually in 1979, we had income tax brackets, believe it or not, of 70% for the wealthiest of individuals in the United States. And so people focused a lot on tax shelters. They had real estate, oil and gas, mining types companies, book deals, leasing, all that kind of stuff. That was big activity because people were trying to manage their taxes and they were able to do that. Well, Congress got angry about people trying to shelter their income and squeezed it down more and more. And finally, they got rid of it a lot by changing the rules. And so we actually have personal service income, which is our salaries, bonuses, commissions, self-employment income from your own business. That's personal service, and that's taxed as ordinary income. Then you have portfolio income, such as dividends, interest, royalties, capital gains, and there's certain deductions that you're allowed, against those. And then there's passive income, limited partnership income, rental income, capital gains on passive activities. That was more the tax shelter thing. And so the Internal Revenue Code manages taxation based on categorization first of income. So it's not just income, it's a type of income, which then determines whether you get ordinary income tax treatment, capital gain treatment, and certain deductions against the types of income you have. Because people would create things that would create a loss and then try to offset against ordinary income from their wages. And so they said, no, we're going to cordon this off and say you can take this deduction against income produced by this kind of activity, but not flow it over to these other types.
So on my regular wage, that's going to be taxed ordinary income tax.
Yeah, full income tax brackets.
Okay. But now on the second one, though, you said about capital gain, capital tax is going to be less.
Well, that's right. If you have you own a stock for more than 12 months, and you bought it for $1,000 and sold it for $1,500, you have a $500 long-term capital gain. Now, there's other rules. You offset capital losses, and there's all these categorizations: short-term, long-term capital gains, short-term, long-term capital losses, and there's a formula of how you pair those up and net them out. And this all comes through Schedule D on the tax return, and it's way too complex to be talking
it's
about
really
on the
important.
show.
It's really important when you think about it that if you have a portfolio, you just need to learn how to harvest tax gains and losses at the end of the year and let them offset each other. I mean, that's the goal, and that's why you need to have a professional in on this.
Well, yeah, and there are a lot of people that use programs like TurboTax and do it themselves, and what they may be missing out there is they're not getting that year-end tax planning of saying, oh, gee, I've got some losses in this portfolio here that if I sold them, I could trigger some capital losses that would help offset capital gains. We say, well, why do you want to offset low-cost gains? Well, if you have short-term capital gains, you held a stock for 6 months and sold it, that's treated as ordinary income for tax purposes. So you might want to have some capital losses to offset that first. And then, of course, what I find patently unfair is that if we have long-term capital gains net, after everything's been added up, you only get to deduct $3,000 against your ordinary income. So you have those capital loss carry forwards, but 3,000 at a time. That's been around for as long as I've been in the business. So 3,000.
No inflation there.
Yeah, 3,000 used to have some benefit. Now it's negligent.
Well, the last one, and people that and a
Negligible.
lot of people are into holding real estate, so they have passive income. Talk a little bit about that.
Well, yeah, and there's different categorizations. If you are a true passive investor, in other words, you hand money over to somebody else to manage and buy the properties or whatever, you might be a limited partner, or you might even be a partner in an LLC. People don't realize that LLCs are taxed like partnerships. Then those losses are going to be offset against other types of passive income, but there's limits on how much you can carry over, and then there's there are some real estate activities that you meet certain rules that you can do some shelter with, but the old days of going out and going to your stockbroker and buying a limited partnership and sheltering your income is gone.
Oh, for those days again, right? Well, listen, when we come back after the break, we're going to talk about next steps because we're right at tax season. You got about a week or so to go. We want to make sure that you understand the next steps and the chronology of planning for this year's taxable event right after the break.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back. Of course, we're with Ken Davis, and Ken, we want to talk about next steps. We don't got too much more time left of the tax code, so we have to kind of prep our 1040. What are the next steps that we need to look at to really get the most out of, because a lot of people think, well, it's too late for that, Steve, December 31, 2012, but actually that's not true.
It's just the opposite. This is the time to do tax planning, and unfortunately, somehow our culture has gotten in the habit of thinking that December is the time to do tax planning, and yes, you can do some then, but not much. And what I mean by that is you can, if you have an IRA, you can contribute now for this year. You don't have to wait to 2014, and the benefit is you not only get a deduction for 2013, but you also get tax deferral on those earnings for another year.
Well, think about this, because let's go back. December 2012 is over.
Right.
But you can still make contributions to your IRA for 2012. And I think a lot of our viewers and consumers, they don't even know this.
Well, and an old style qualified plan for businesses still is available, which is the SEP IRA, can still be set up and funded. All other qualified plans had to be in place by December 31st. The SEP IRA is the only exception to that rule, and so there's still some planning for businesses wanting to set up plans for themselves and their employees.
And that's a pretty good chunk of money, too.
Oh, it can be a very substantial amount of money. So SEP IRAs can be attractive. Funding for this year's contribution. In fact, you could fund for last year and this year and get it in. And the sooner you get in and get tax deferral, a lot of our focus is on tax deduction, but over many years, tax deferral is actually much more powerful than tax deductions. It's like getting a whole bunch of mini tax deductions. That interest, like say you made 8% return, that 8% is not taxed. That is, in a way, a tax deduction for the earnings. Okay, we call it deferral, but it's, in a way, a tax deduction. And when you pile those up and then you compound them, there's a period of time where that actually more than pulls ahead of the initial tax deduction. Emotionally, it's more attractive to get the deduction, but the fact is deferral is really important. So the beginning of the year is where you start your deferral process, not the end of the year.
Yeah, we have information that, of course, if you request it, here's the calculation on procrastination. Just that 1 year delay can make a big number and big difference. But I like that we have IRAs, and people that are 50 and older actually can put a little bit more in.
Yep. They can. I think the law now allows them to put another $1,000
on top of the regular contribution.
Right. Correct. And so those contribution levels are adjusted for inflation each year. And by the way, for our viewers, inflation adjustment is always good in the tax law, because if you have exemptions or credits or certain thresholds for making computations of taxation, the higher those thresholds are, the better for you it is. And so if those are adjusted for inflation each year, we're better off. It stays with inflation. Over 20, 25 years, what was a large threshold or a high deduction really is almost meaningless after inflation chips away at it.
So if you have room in your budget to put in qualified plan, like an IRA, or if you're a business with a SEP IRA, a SEP IRA, this is still the time. You got till April 15th to get this done.
Well, let's not forget that the whole concept of Roth, and it's wonderful that over the years people have become aware of what a Roth concept is, which is no deduction up front, but you get tax deferral in between, meaning your earnings aren't taxable each year, and ultimately at the end they're tax-free. And in addition to IRAs and qualified plans and Roth IRAs and Roth 401k plans, which a lot of people don't know exist, there are certain types of financial products that your financial advisor can bring up that will give you a very similar effect of a Roth, but with higher contribution levels.
Well, let's just go down that road for a second, because I think you just said something about 2 minutes ago that caught my ear. When we're looking at tax deferral, and the longer I hold, it could supersede a tax deduction.
Correct.
So the longer I hold it, so if I have a Roth, everybody bemoans the fact, oh, the Roth doesn't get a deduction. Well, maybe that's okay because I'm going to be taking it out tax-free. And by the way, little question. Ken, does a Roth IRA, when we take our money out, does that have any calculation to do with our Social Security?
No, and I'm so glad you brought that up, because I was thinking the same thing. Because we talk about, should I do Roth or shouldn't I do Roth, and which is better of the two? Well, the fact is, if tax rates are exactly the same on the front end and the back end, pretty much it's a toss-up. It doesn't matter, okay? I know that's counterintuitive, but that's pretty much it. However, if you assume, like many of us do, that tax rates will continue to rise because of the massive debt that our government has spent, then it's likely we will see higher tax rates. But more importantly, and most of the articles and analysis I've seen misses this on the regular IRA to Roth conversion, is what is the effective tax rate? And what I mean by that is, if you have income over a certain threshold, your Social Security is now going to be taxed. First, 50% of it's included in taxation. You reach another threshold, 85% of it's going to be included, until you've included the entire 85% of your Social Security. Well, if you're taking IRA distributions, that could contribute to that formula that causes your Social Security to be taxed. So if you have a Roth IRA, money coming out, that doesn't go into gross income, that doesn't cause your Social Security to be included. So that by itself may be a reason to do Roth over a regular.
When you think about it, these are the things that you need to be talking about. You still got a week or so to go to get these taxes in, and if you're thinking about putting money aside, wow, a tax deferral product might beat the tax deduction over time. Remember, it's not how much money you make, it's how much money you keep. And we've partnered with financial professionals who understand taxes and its impact on saving money. So for more information on how you can pay less in taxes and keep more of your money, just go out to the show's website at www.oneforthemoney.tv. And remember, you can follow me on Twitter and visit me on all my social media network sites, Facebook, LinkedIn, YouTube, and Google+. That's One for the Money.